Good.
All right. Hello, everybody. It is Wednesday. Um, we're laughing because we actually have been live for like the last 25 minutes, but we realized that for some reason Facebook keeps resetting where it just shows our lives to us. And so we had to reset it, and now we are coming live in public. So, with that being said, it is Wednesday. Happy pre-Thanksgiving. Thank you for being patient with us. For those of you all who text us asking us where were we, thank you for even caring. So we're here, and today we're going to talk about ETFs. It's one of those things people know that they exist, but they don't know why. Don't really know how to use them. Don't know the difference between ETFs and mutual funds. And for me, particular, this is a really interesting topic because having been a licensed financial advisor, coming from the early 2000s when I got licensed, 2001. I'm no longer licensed for anybody watching. My licenses are all on the shelf. But one of the things that we're like taught, every financial advisor is taught, is get your clients in mutual funds, get your clients in mutual funds, get your clients in mutual funds. And that was like the big thing, especially like mid 2000s. It started moving more towards managed money. Like, if it's 50,000 or more, let's try to find a managed money platform. But it still was that era where everybody wanted to essentially get you into a mutual fund. And many people didn't know why. It's because it was very simple. And the thought was, if you can diversify, that's one of the best things you can do. And there were no real ETFs on the market at that time. It's a relatively new thing in the market, investment type in the market, and it's still becoming readily accepted by the general marketplace. So we're going to dive into that. But first, we also want to say we know a lot of you all have been on the fence. Like, I've been watching you all from Investment Education Academy. Some of my friends, in some cases, some of my family have joined. I'm interested, but I still don't know if it makes sense for me or if I can, write the check to join right now. Well, let me say this. If you have money in the market, and I really do mean this, if you have money in the market, I honestly think you should be a member of Investment Education Academy, because there are a lot of people out there who, claim to be gurus. And Leon and I don't. We have a lot of information about the stock market. We know a lot about the stock market and how it works. But we also know how to allow our members to find their own way, their own style of investing, and we just guide them. Our way isn't the only way. Leon and I don't even invest exactly the same. So when you come into our ecosystem, um, you're getting a large perspective of ways to invest, not just one. In addition to that, we decided, and I'm gonna give Leon the credit for this one, that we would do a 50% off on our community membership and our insider membership up until midnight Friday. Again, I'm giving Leon credit for that. We are doing a 50% off membership for anyone who's interested in joining IEA, now until Friday at midnight. And so the website is already structured to receive anybody with our Black Friday special. The prices are already listed on our website, and that's www.iea.members.com. Again, www.iea.members.com. I will drop the link during the course of the podcast, but I do want to welcome some of our newer, members, and just say, for those of you all who have been kind of thinking about it, this is your opportunity. And we know some people have been buying IEA memberships for gifts. This is a great time to, get a membership for somebody in your family that you thought would actually benefit from the information. So, with that being said, we're going to jump back into ETFs. And before the end of today, hopefully we'll have it ready. We're going to be selling two of our lists. One, we have a list of 20 cybersecurity stocks that you should be aware of if you're an investor. And we have a list of 17 stocks that are composed Apple's ecosystem as it stands right now. They're not only the only ones, but they're 17 of the stocks that compose Apple's ecosystem, many of which you might not know about. Some you probably do. Leon and I have actually put together a list through IEA, and we're going to be making that list available for purchase for those people who are not members. If you are a member, it's going to be available to you as well, but at a much cheaper price. So we're going to, get started. Please share this live today with someone who needs it. The information will be really good because there's a lot of confusion as to what ETFs are and how they work. And Leon, while you give them a little bit more, I'm going to do a little bit of housekeeping.
Okay, yeah. So ETFs are a great way to add diversification to a portfolio. So Brent and I we're big on risk management. We do it different, but we are big on risk management. Brent is more the investor who will trail his stops. In other words, once something runs up, he'll then try to lock in gains. So if it drops a certain percentage, he'll then get out. Me, I take my risk and I spread it across a wide swath of stocks, so that one of the lives podcast we did a few weeks ago, one of my stocks that was down 80%, I didn't even notice it. So we have a different way to manage risk. But one way that I take.
Lee, real quick, I got to jump in and say this. So I'll overfund certain portions of my portfolio, which is my style, right? I wouldn't even suggest it to most people, to be honest with you. I really would go for diversification, not exceeding maybe 8 and 10% on any given stock in your portfolio. Leon does, I think, 6. But I overfunded a position. Last time we talked, I remember I was like, yeah, I do overfund because I did with Tesla. I overfunded Tesla. So Tesla held like a 25% position in one of my an account that I assist with. In the last 3 days, that account has probably grown about $30,000. It's been crazy, but very risky. I don't suggest it to most people, but sometimes you do win.
Oh yeah, without question. Now, but what would hurt is if it went the other way.
It did though. Down. It was, and so this is the thing too. Let's talk about that, right? We talk about the good, and and Leon and I are very candid about this. That same portfolio was down like $13,000 in I say October the 4th or somewhere in that range. And we decided not to bail, which very easily, again, we talk about the buy hold strategy. We talk about, do you have the stomach to kind of get through it? And we had the stomach to get through it. And now the portfolio is up. It's up 33, but about 27 of that is from Tesla alone. And
$1,000, not percent, right?
Yeah, $1,000.
Yeah. Okay.
But it just goes to show, like, being overweighted hurt us really bad when we were looking at like that October timeframe. But being experienced in the market, we knew sound company, sound principles, and honestly, I think Tesla's it's going to be some pullback. So for anybody watching this, I'm full disclosure, I think Tesla's going to experience pullback, especially with so many EV companies coming in. But that's not today's topic. So I'm going to jump out and I'm going to continue my maintenance.
Yeah. So ETFs. So ETFs allow you to get diversification instantly to your portfolio, and we'll kind of show why. So just real quick background on ETFs. So what it stands. So Brent, you can throw a slide one when you get a chance.
Okay.
ETF stands for Exchange Traded Fund, and people from Brent and I generation, we came up on what things called mutual funds. A lot of people may have heard of them, may not, but mutual fund is a similar concept in that mutual funds are a pool of money that invests in typically a particular sector, particular industry. But the difference is that with mutual funds, a lot of times some of them will have minimum investment you have to put in. So for instance, a mutual fund may say your minimum investment you have to put in is like $3,000. I know Brent said before he had heard of some that have minimums of like $50,000. But some of them don't. Some of them don't have minimums either. So that's one difference, is that ETFs do not have minimums. They trade just like stocks. You can buy a share. You can buy 20 shares. You can buy 100 shares. Whereas with mutual funds, there sometimes there's a minimum buy-in. Another thing that's different is you cannot trade a mutual fund during the day. So mutual funds, it's what they call it. It settles at the end of each day. So today at 4 o'clock, mutual fund XYZ closed, and let's say it closed at $50. If you go look at mutual fund XYZ tomorrow at 2 o'clock in the afternoon, saying, okay, what's the price? It's still going to show $50, because again, it doesn't settle to the end of that day. So at the end of, say, tomorrow, what the company does, they say, okay, what are all of our assets worth today? Which would typically be all the stocks in the portfolio. What are they worth right now? And then once they get the price, then they'll sell that price at 4 p.m. and then you can see it at 4 p.m. or thereafter. So so mutual funds do not trade during the day because they do not trade on exchanges.
Yep.
Mutual fund. Yeah, go ahead.
One of the things, we talked about just a moment ago.
A moment ago, that nobody saw.
Why does that matter, right? And the example that was given was essentially, if you're trying to defend a position and at 10 o'clock some news just hit, something's going on that is going to negatively affect the market widespread. And although, yes, your mutual fund is diversified across a plane of investments, depending on what the mutual fund is, it's going to be growth mutual fund, international mutual fund, bond fund. It's going to be something, right? It's going to be in a sector. And so when you have that mutual fund and this news is hit, you cannot do anything until the end of the trade day. And the fund, regardless of when you call, if you call it 10 a.m., the market just opened, but yes, you can't actually your trade cannot be executed until the market closes. That puts a lot of stress on an investor, where in an ETF, it can be an immediate transaction.
Mm-hmm. A perfect example is that is like today. So I don't know if anybody heard, but so today at about noon, news came out that Salesforce was in talks to buy Slack. And when that news came out, the stock shot up. I mean, it was at one point, I think at the time it was up like 2%. That news came out about noon, and the stock was actually halted. And then when it started trading again, it shot up by 25 to 30%.
What?
Now, just imagine
today?
had that been the other, huh? Yeah, today.
CRM.
CRM is looking to buy Slack, which is their Slack symbol is work, WORK. And so just imagine had that been the news been the other way. Let's say that that news actually negatively affected Slack. The stock could have been down 30%. And if you're in a mutual fund, you cannot do anything about that position until the close. So you have to absorb that whole 30% drawdown or drop in your account until it closes, and then try to get out. So that's what, like Brent said, that can be very stressful. If you're a more short-term trader. I mean, not everybody's buy and hold. If you're more of a short-term trader and you saw something like that hit the wire and you wanted to maybe liquidate some of your position or maybe all your position, you could not do that in a mutual fund. Whereas in an ETF, you could. ETFs, again, they're similar to mutual funds. They typically trade within a particular sector, but they trade like stocks. And they trade on an exchange. So you can go in there and see the tick by tick change of the price. You can get in and out at any given time. Whereas again, with the mutual fund, you can't get out to the end of the day. So the chart we have up here, the graph we have up here, or the slide we have up here, just a few bullet points of what ETFs are. First one is ETF stands for Exchange Traded Fund. They're similar-ish to mutual funds, as I said. And the similar-ish portion is that they mutual funds and ETFs typically trade or follow different sectors or different industries. But the way you get in and out of them are way different, as we just explained. One below that says ETF typically follow a sector or an index. You find many ETFs that track the S&P 500, the Russell 2000, the NASDAQ 100, and different sectors like technology, industrials, what have you. They're like stocks, they have ticker symbols. So they're typically between 3 and 4 letters will be the ticker symbol for an ETF. And the last point is they add instant stock diversification, and which is great. So think about it. If you want to buy into, say, the industrial sector, and there are 20 stocks in that sector, instead of having to try to pick out, okay, which one may win, which one may lose, you can just buy the ETF, and now you have exposure to all 21 stocks in that particular portfolio in that ETF. So that's how they add instant stock diversification. You slide 2, Brent. Now here we have 3 examples of some ETFs. So these are some of the more popular. Well, I don't say popular, but some of the more well-known ones in the industry. So the first one is JETS, JETS. Ticker symbol is JETS, JETS. It's a domestic, international, and it covers the domestic, international, and airline sector. Inside that ETF, there are 41 stocks, right? 41 stocks. Now, imagine trying to pick the winner or the loser in the airline industry. We all know about Delta Airlines and Southwest Airlines, but inside that, there are a bunch of companies that service that do parts, do labor, and what have you. I mean, there's a whole ecosystem around the airline industry. We don't know them all, and we may miss out on some opportunities because we don't know them all. Well, if you buy JETS, you get all of those, you get all 41 in one buy, in one share. So that's JETS. Another one is XLK, which covers the general technology sector. Again, in that, there's 76 stocks. So you buy, you buy an XLK, you now own a piece of 76 different companies at one time. You don't have to pick a winner, you don't have to pick a loser. You just buy into that and you're now well diversified. And the last one is POTX or POTX. This covers the marijuana or pot industry. And inside that, there are 25 different stocks. Again, don't have to worry about trying to pick winners or losers. You just buy the ETF, and now you're diversified within that particular sector. Now, one thing I want to say is that when you buy a sector ETF, you're only diversified within that sector. Well, you're diversified within the stocks in that sector. You're not diversified by sector. So if you buy jets, if the airline industry takes a hit, jets is going to take a hit, right? So just because you're diversified within the airline sector doesn't mean you're like, if anything happens, you're not going to feel it. You're still going to feel it. That's why you want to buy different ETFs that are in different sectors. So if jets takes a hit and technology's up that day, you're also an XLK, it'll balance out. So so you always want so ETFs give you stock diversification within a sector, but you also want to be sector diversified by buying different ETFs in different sectors. So that was a point on that.
And also too, if you think about, how much money, how do most of us have enough money to buy 76 different stocks,
Mm-hmm.
And when you go out and you get an ETF, and this plays true for mutual funds, but we're talking about ETFs today. You're able to get a piece of each of these. And for those of y'all who are wondering, what does a piece mean? Like, it's a fractional share? Yes. So this is essentially you getting a fractional share. But what happens is you're getting so many people who are investing into that ETF. They then use those funds to go out and, purchase different shares of all these companies. And then in book value, you have a percentage ownership in each of the companies. Very small, but you own the ETF and the ETF owns pieces of this. But what it does is it moves your money into institutional money place. And when your money gets into that institutional money sector, you may be getting into investments that others can't, because they have the power to have institutional entry into certain investments that are restricted for retail investors.
And one thing, like Brent said, with institutions, institutions have analysts, millions and maybe billions of dollars to do all this research. And so these ETFs a lot of times are actually products of these institutions. There are actually ETF firms that their staff are nothing but research analysts that go out and do all these research on these different companies and then build these ETFs around them. So when you buy these ETFs, you're basically following professional money. Are they always right? Not at all. We all know no one's always right in the market. But it can give you a bit of an assist to say, okay, you're going to follow some of this research, some of this big money into these ETFs. Now, a different point is one point Brent often makes is that when you buy ETFs, so remember, everything's about risk reward, right? So ETFs are less risky, so therefore you're going to get less reward because you're so diversified in these ETFs that if you own Delta, say you own Delta, the airline, and if Delta's up 20% one day, right, you just be killing it. But if you own Delta, you're doing great, right? But if you own jets, you may only see like a 2 or 3% gain. Because if Delta's up 20%, but all the other stocks, all the other 40 stocks in jets are just up, 20%, or maybe 3 or 4%, some are down 10%, it averages out that you may only see like a 4% gain. Whereas if you were just in Delta, you'd be up 20%. So there's a point Brent often makes is that he's not so much a fan of ETFs because they limit your reward, which is true. I mean, that's just a fact. But also, the flip side is that they limit your losses as well. Same thing. If Delta was down 20% and you're in jets, you probably maybe see a loss of maybe 2 to 3%, or you may even be up a little bit because all those other stocks will balance you out and may take you positive. So the trade-offs, ETFs are trade-offs, but if you're looking for diversification and a way to get into many stocks without having to do a ton of research, ETFs are great.
And for everybody who's watching right now, we may mention some of you all just come on. We're actually doing a Black Friday sale until midnight on Friday. So you all will get, and thank Leon for this one, 50% off our membership for IEA community membership and IEA insider membership, 50% off. Now, for anybody who's wondering, well, what about the Panthers, Portfolio Panthers? If you're interested in becoming a Portfolio Panther, you actually will receive a 20% discount for entry into the Portfolio Panthers. And we're happy to say we've actually moved into land acquisition. So for anybody wondering, I know IEA says will help demystify the stock market and other investments. What are the other investments? They have now become fashion, the shoe marketplace, sneaker, specifically sneaker marketplace. And we have just done the acquisition of some land. And we're going to tell more about that. I don't know when, if it's going to be at the end of this or next week or when, but just kind of dropping that. We're looking at doing more in that space too. So for those of you all who are interested in IEA membership as a whole, community membership and insider membership, both are 50% off until Friday at midnight. If you are interested in becoming a Portfolio Panther, that membership is 20% off until midnight on Friday.
Okay, so so as you said, gives you great diversification. Wait, hold on, can you go back real quick? On two. So so I just want to say, make a point at the bottom is that these are three. So what I identify here are three different ETFs, but we actually found 74 different sector ETFs that cover everything from cloud computing to ESG to blockchain to robotics and AI. I mean, there's basically ETFs out here for everything under the sun. And we found 74. 74 isn't all of them, but the ones that we went through and kind of identified as things that we would invest our own money in that we're comfortable with, we found 74. And those 74 will be made available, as Brent said, for that the purchase deal we'll have through, I think it's through, like Brent said, through Friday. And then for current IEA members, it'll be available on the platform for.
Oh, I didn't say that, actually. I didn't say it on this one. So.
Oh, yeah, because no one, nobody saw it. Yeah.
So we've been asked a lot, if we would have some of our stock picks or some of the lists that we talk about available for purchase for people who are not IEA members. And initially the thought was no, but with everything considered, Black Friday sales, and also just looking at providing people information they want, we decided we would actually make it available to those who are not IEA members. And we're going to have a link for that probably, if it's not up tonight, it'll be up tomorrow. However, if you are an IEA member and you are interested in one of these lists, please send us you can send us a message inside the IEA membership platform, and we will give you the IEA pricing for the list, not the general population pricing. So if you're interested in the two lists that we have right now, are the 20 cybersecurity stocks that you definitely should know about. And then we have a list of 17 stocks that make up parts of the Apple ecosystem. And, we go back to the research part of this. There's so many stocks out there that we just know nothing about. If you don't do, a ton of research, even when you do, sometimes things are just missed. And so this list, we're not saying is to complete everything of, every component of Apple's ecosystem. However, it is 17 stocks that you should look at that are part of the ecosystem where we did the research, we curated it, and we're providing it to you as a service. And, the pricing for both of these are definitely extremely reasonable, considering if there's a 10 to 15% move in any of these stocks, it will more than pay for itself over the course of like 6 months or so. But again, we are going to make it available. I will put the link up later. I did not mention that earlier, so thank you for reminding me, Leon.
Yeah. So yes, I was saying the last point is that, like I said, this list here we curated has 74 different sectors. Yeah, like everything covered. Like I said, cloud computing, ESG, blockchain, robotic AI. I mean, there's some of them. We also have like industrial. We have some of the major sectors also, technology. Hospitality, what have you. So we definitely do a lot of research on the back end, and that's how we provide these lives every week. So if you go to slide 3. So the IEA takeaways are ETFs are typically specific to an index or an industry. As we said, when we showed, were the airline industry, the technology industry, and the marijuana industry. Those are just 3 of the many out here. They add instant stock diversification to a portfolio, but not sector diversification. So if you're buying jets, you're only in the airline industry. Don't think if you buy jets now you just diversified throughout the market. No, you're only in jets. If you buy a pot, you're only in pot. If you buy an XOK, you're only in technology. You still want to buy multiple ETFs across different sectors. So you're stock diversified and you're sector diversified. This diversification helps reduce portfolio risk, which it does, as I said before. A few stocks are up, a few stocks will be down. They'll typically even out. Maybe you may have a small gain or a small loss. but you won't experience the crazy volatility if you were just, if you're just in one or two stocks. And the reduced risk, also reduced reward. As Brent often talks about, ETFs give you less reward, which is true. It's a fact. And I've come around to that a little more. Like I used to be all about ETFs because I thought they were best things for sliced bread. But since I've been doing a lot of this research and a lot of this studying, they definitely move a lot slower than stocks. I mean, as Brent said, Tesla is up, I don't know, what is it up in the last month?
It's probably about 20, almost 20% or 20%.
Yeah, 15-20%. And I can almost guarantee there are, well, not guarantee. I could give a good argument that there aren't many ETFs out here that are up 20% in the last month like Tesla. So that's where you lose some of that reward when you have less risk. But again, if you're looking for less risk, less volatility in your profit and loss statements, ETFs are great. So yeah, that covers our live for today. Definitely ETFs. If you're looking for diversification, look, you can Google ETFs, sector ETFs. You can find a lot more on your own. But as Brent said, we have quite a few that we've curated ourselves that we're going to be putting out there soon.
Yeah, and I mean this is great because it leads us right into our stock picks, and I know a lot of you all watch for the stock picks. I'm picking. Let me pull it up. It is XPing. XPing is trades under ticker symbol XPEV, and it's what's called an American Depository Receipt. That just means it's a foreign stock trading on an American exchange as if it was an American-based company. This is my way of covering the EV or electric vehicle marketplace. There are some states like California whose goal it is to have a complete EV-based transit system. And I mean, as we go there, you have to think electronic vehicles are still extremely new as it relates to sales and acceptance in the American marketplace. Actually, I mean, globally, honestly. So the sector has a lot of potential for growth. XPeng is a newer company coming to the market. And up until, I don't think they have a 5-year chart on them. They came public.
They're new.
Yeah, they came public, I think, in July.
Yeah.
And so when they first came public, people didn't know what to do with them. They didn't know what box they fit in. They're up over 100% since their IPO. So they're not going to pay dividends. They do have a market cap of 46 billion, which I really like. As Leon and I know, Leon and I aren't huge fans of small cap companies. And those are normally companies with a few hundred million in market cap. I think it might be up to $1 billion. You might still be a small cap, and from 1 billion to maybe 10 billion, you're a mid cap. 10 billion and above, you're a large cap. If those numbers about right, Leon?
Yeah, that's right. Yep. Mm-hmm.
Yeah. So them being a large cap company, it really just makes sense for me to have them as a hedge in the EV space. There are going to be a lot of players in this area. They're not going to be the only ones, but for me, for today, I'm choosing XPeng as a way of and this is where diversification will come into play for me, right? I'm not going to just buy Tesla and think Tesla's going to be the fastest, best dog in the show every time. It's not going to happen. So this is how I diversify in certain sectors to make sure I have sector diversification and I don't have single stock risk. And some people might not see that as a strategy, but it actually is for me.
And another thing about that is you were saying about California. I think they passed a law. I think it's by 2030. You can't sell gasoline powered cars anymore. If it's already in the road, it's fine. But I believe it's about 2030 that California is phasing out new car sales of gasoline powered cars. Mm-hmm. So and California is the largest state in the country. So that tells you where the U.S. is going. So all right. So my pick is a company called Fortinet. Ticker symbol is Bro, you didn't get the ticker symbol on this.
Yeah, I'm waiting.
On yours.
Oh, I'm sorry. XPEV. The ticker symbol for XPeng is XPEV.
Yeah.
So I was waiting for the ticker symbol for you. I was like, yeah, I have no idea.
Yeah. So mine is called Fortinet. ticker symbol is FTNT. They're basically cybersecurity. They sell what they sell. They sell firewall, antivirus, intrusion protection, and endpoint security to large companies and governments. Reason I'm just crazy bullish on cybersecurity is one, everything's moving to technology, as we all know. And with this new stay-at-home economy, you know, who knows what's going to happen in the next year or 2 years. People are now working from home. They're working remotely. They're working in different cities now. Security for these remote workers is going to be huge business in the future. It is now, and it's going to be in the future as more people work remotely. So that's one reason I chose them. Another reason is that tech isn't going anywhere, right? I mean, like tech is ruling, as one, I think it was Mark Andreessen back in the day said, software is eating the world. And what he meant by that is software just taking over everything. Well, it's gone from software now just to kind of general tech. And all this tech has to be secured, right? It has to be secured in the end. And Fortinet is one of the companies that is doing that. A few stats on them. So the 3-year average for revenue, they're growing at 19% per year. And they're growing their profits a whopping 200% on average over the last 3 years. 250% on average over the last 3 years is what they're growing their profits at. Now, we'll say one of those years was the majority of that. I believe it was I think it was 2018 and 2019, which kind of skews the average. But even around that, they were still growing. They were still growing their revenues. I think it was from 30 to 50%. And then from 2019 to 2020, year over year, they grew their profits 17%. So solid profits, solid revenues, solid company, because again, they're dealing in the space of cybersecurity, which has to secure all this tech that we're using. And over the last year, the stock is up 15%.
Yeah,
so,
and you know, I'll jump in on that because you know you talk about cybersecurity, and even when we're talking about these EV cars, all these cars are electronic, and the future is the new break-in is going to be, you know, some person with a laptop. It's not going to be a person with a crowbar. And so when you look at what's happening, you're going to have to secure cars, home. I mean, we're really moving towards a keyless society where we just walk in and everything's, you know, we're identified wherever we go. Our credit cards live on the internet. Our information travels at light speed. You have to secure it. So I like this one.
Cool. Yep.
All right. So for everybody, again, if you're interested in membership, you can definitely take advantage of our Black Friday sales. You will start seeing us advertise it after this live. You know, we'll send out a notice. But we look forward to watching the membership grow. We're approaching the end of the year. A lot of you all, we already know your New Year's resolution is going to be to, you know, get your finances right. That's like one of the top, that and losing weight are like the top New Year's resolutions. So why wait? You have the opportunity to get into Invest in Education Academy's membership platform for 50% off. It hasn't been done before. So, and that's not even like a sales tactic. It just literally has never been done. So we hope that you take advantage. We thank you for being with us, and we will see you all next Wednesday, if not before then.